I'm going to be making several videos for grade 10 accounting as we go through the year. Today's topic is Accounting Equation, or as it's frequently known, AOL. Before I start going through that, I just want to remind you of the journals and the source documents which are used to complete the journals. Source documents are a written record of a transaction and must be completed to provide proof as well as so that you can use the information contained to complete your journals. Alright, starting with the cash receipts journal, which is used when money is received by the business. Now there are three different possibilities here in terms of source documents. If direct deposits are made into the business bank account, in other words, people don't come to the business, they go straight to the bank. You will find out about that transaction by looking at the bank statement. Then you have cash sales. For cash sales, it's not necessary to keep a record of the customer's name, and you also need a system where you can record the customer's purchases from you, which are usually large quantities, quickly. So you do that by making use of a cash register, or as you know it, a till. So the document for the cash sales will be a cash register tape, another name for till slip. If the person comes into your bank, into the business rather, to pay an account, and we need to know who he is, keep a record of his name, then you're going to issue that customer with a receipt. So cash sales, you don't need to know the person's name, but if we do need to know a person's name, we're going to give them a receipt. Right, then for the cash payments journal, that's basically payments used either making payments by EFT or by debit card or withdrawing cash. And your document for that is either bank statement or EFT. If you make payments using petty cash, those get recorded in the petty cash journal, and the document here is petty cash voucher. It's quite an important document to keep good internal control over your petty cash. You need to know what the petty cash is being used for. If the business sells on credit sales, that gets recorded in the debtors journal, and the document is an invoice. If the business buys on credit purchases, that gets recorded in the creditors journal, and that is also an invoice. Sometimes the debtors return stock, or for whatever reason we give them an allowance. If that takes place, you're going to record in the debtors allowances journal, and your document for that is a credit note. And then if we return to our suppliers, or our creditor gives us an allowance, that gets recorded in the creditor's allowances journal, and your source document for that is either debit note or credit note. It's going to be a debit note that we issue when we return stock or various items. If the supplier agrees, they give us a credit note. So either of those are acceptable. Alright, then just quickly some terminology. The assets of the business are the belongings of the business and have got lasting value. Your expenses are your daily running costs. An example I use here is a motor vehicle. That motor vehicle belongs to the business and is an asset. But if you don't put petrol in the motor vehicle, it can't go anywhere. So just the same with the business. You can have all the assets that you like, but if you don't pay things like electricity, wages, telephone, stationery, etc., your business cannot function. So those are your expenses. Income is any amounts earned by the business. The most common one you deal with here is your sales. Liabilities are the debts of a business, what you owe to outsiders. And then owner's equity is the worth of the business. Okay, so owner's equity, what the business is actually worth. Now when we're dealing with these transactions, to assist, I make use of this equation. Assets plus expenses must equal liabilities plus income plus capital. Assets and expenses are on the left of the equal sign, so they increase on the left, and obviously then decrease on the right. Liabilities, income, and capital are on the right of the equal sign, so they increase on the right and decrease on the left. Now when we're going to complete the table shortly, we're going to follow the following method. We're going to ask 3 questions. Question number 1 is what accounts will change. Question number 2, what type of account is each? And question number 3, is the account increasing or decreasing? Alright, just quickly, before we get to the table, I just want to go through a quick example on identifying journals that you need to use. If you issue an invoice for stock, it means you have sold on credit, so that will get recorded in the debtors journal. If you receive a credit note for stock returned, it means you have returned, so that gets recorded in the CAJ with the source document credit notes. If you buy stock, payment made using a credit card is not a store card. Okay, so it's not buying on credit. It's treated by the business you're paying as cash because they can get the money straight from the bank. They don't have to wait for you to pay back. So that will go in the cash payments journal and your document will be bank statement. And then if you issue a receipt to a customer who paid his account, that is going to get recorded in the CRJ because you're receiving money. You need to know his name, so the document is a receipt. And then settlement discount was received from a supplier. You will receive settlement discount if you pay back somebody. So the source document for that, the journal for that will be cash payments journal. Isn't actually a source document for the discount that you receive. You will just need to make a note of it and then record it in the CPJ. Alright, and then I want to just look at this table now. The table has the following headings. Account debit and account credit, that's what happens in the general ledger. There's an amount column and then there are columns for AOL. Now you need to remember, very important, that A must equal O plus L. To help my classes remember to check that each side is equal, I've drawn this line here where the equal sign is. I've done it in blue. So after every transaction you can check, does the left hand side of the blue line equal the right hand side of the blue line? Alright, let's have a look at the transactions. The first one. A discount of 30 Rand account balance 600 Rand was received when a debit card was used to settle our account. Show both entries, payments and discount. I remind you now of these 3 questions. What accounts will change? If you're paying back and getting a discount, it's going to be bank, creditors control and discount received. And then what type of account is each? Now I use little T accounts here and do this in rough working because it will help you to get things on the right side at the top here. So creditors controls a liability, it's minus plus. Discount received is income, it's also minus plus. Bank is an asset, plus minus. Alright, now let's ask what's happening to the accounts. If we pay back money, the amount of money we've got decreases. So put an X on the minus side. The amount we owe our creditor also goes down because we are paying back, so put an X on the minus side. And then you've received more discount, so put an X on the plus side, the credit side. Now when you do the table above, the account that's got the X on the debit side is creditors control, and the credit side is bank. That was for the amount of money we paid. And then creditors control and discount received is on the credit side. This one's on the debit side, and that's for the discount we got back. Now in terms of this accounting equation, bank is an asset going down, so you put a minus. Creditors control is a liability going down because you're paying back, so you put a minus, and nothing happens to your owner's equity. You must show that as a 0. Now if you check, on the left of the blue line we've got a minus, on the right of the blue line we've got a minus as well, so the 2 sides are the same. Alright, and then in terms of this discount, the creditor's control goes down if you're given discount by your creditor, so that will be a minus under L, and discount received is income. If you receive discount, okay, the worth of the business goes up because you've earned income. Nothing happens to your assets. Now check. On the right of the equal sign, we've added 30 and we've minus 30, which gives us 0. On the left of the equal sign, you've also got 0. Alright, the next transaction. Received 6720 from NBS for a fixed deposit of 6,000 which matured and interest for the year. We're going to need to use two lines here. One for the 6,000 and one for the 720 Rand interest. And now we start with our accounts. The accounts that are affected here is going to be your bank, your fixed deposit, and interest on fixed deposit. Bank is an asset plus minus. Fixed deposit is also an asset plus minus. Interest on fixed deposit is a liability minus plus. Okay, bank is increasing if you receive money. The fixed deposit is matured now, so you don't have that fixed deposit anymore, so fixed deposit decreases. So put an X on the minus sign. And the amount of interest you have received has increased, so put an X on the plus sign. Now take the information and transfer it up. So bank has got an X on the debit side, fixed deposit, the X was on the credit side. Then bank was the X on the debit side again, and interest on fixed deposit, which is income. You have to use two lines for this. Alright, and then in terms of AOL, bank is an asset going up, and fixed deposit is an asset going down. Nothing happens to owners or liabilities. Can you see, if you add 6,000 and minus 6,000, you get 0, which is what you've got on this side as well. And then bank is an asset going up, so you put a plus under A. Interest on fixed deposit is income. Income increases the worth of the business, so you put a plus under O. Okay, the next one. The owner increases capital contribution by 50,000 Rand. The two accounts that change there will be bank and capital. The bank account of the business is increasing and the amount of capital is increasing. So now we look at our table. The X is on the debit side of bank. The X is on the credit side of capital. Bank is an asset going up and capital increases your owner's equity. On the left we've added 50,000, on the right we've added 50,000. So that equation is equal. Right, then the next one, the owner took some money from till to buy himself lunch. You mustn't mix up cash float and petty cash. Cash float is the money you leave in your till so you can give change to customers. Petty cash is when you keep some money aside and you use it to make small payments where you don't want to pay by EFT. So for this one here then, the owner is taking money out of the till, so he's taking money out of the cash float basically. Whenever the owner takes something for himself, it's regarded as drawings. Now, drawings is opposite to capital. Capital is minus plus, which makes drawings plus minus. And cash float is an asset. That money in the till belongs to the business. The amount of drawings have increased. The amount of money in your cash float has decreased. So come to your table. Drawings has got the X on the debit side and takes down owner's equity. When the owner takes back money for himself, the worth of the business goes down. Cash float is an asset going down, so it's minus under A. Minus that side, it's equal. Alright, and then the next one, cash sales 5,000, cost price 3,000. For this one we're going to need to use two lines. one for the 5,000 and one line for the 3,000. Alright, and you must put the accounts together correctly. The bank account will go with sales, and the trading stock and cost of sales will go together here. So bank is an asset going up, so put an X on the debit side. Sales is income, put an X on the credit side. The amount of stock left in the business is going down. Customers are taking it, so minus X rather on the minus side. And then cost of sales is an expense going up. When you transfer this here, bank has the X on the debit side, sales has the X on the credit side. Bank is an asset going up, sales is income which increases owner's equity. And then in terms of this one here, your trading stock is an asset going down, so you put a minus under assets, and cost of sales is an expense. The higher your expenses, the lower your worth, which is low your worth of the business, so it's minus under your owner's equity. Now if you have a look over here, we've added 5 and we've subtracted 3. The difference is 2,000, and that will be the amount of profit that the business has made. 2,000 Rand. Right, then, the owner used petty cash to buy his son a hockey stick. If you are using petty cash for the owner's use, your two accounts will be drawings and petty cash. Drawings is opposite to capital, so it's plus minus, and the drawings are increasing here. The amount of money in the petty cash box has decreased, so petty cash will be credited. So if you have a look here then, you're going to debit the drawings, that's where the X is on the debit side, and you're going to credit petty cash. Petty cash is the asset going down, drawings is opposite to capital, it decreases the worth of the business. Okay, the next one. The bank charged the business 350 Rand interest on overdraft. Assume bank was an overdraft for this transaction. Right, the two accounts here is taking money, so one must be bank. The other account is interest on overdraft. Okay, interest on overdraft here is an expense which is increasing, and that's increased on the debit side. Now I've made an error here because bank is actually now liability. So that there should actually be the minus and the plus should be this side. So when you're going through this, change this if you're writing anything down. So bank becomes a liability. The amount of interest goes up. The amount of your liability will go up because you're being charged interest. So with your equation, interest on overdraft is the amount on the debit side, bank has the amount on the credit side. Interest on overdraft is an expense which decreases the worth of the business, and bank overdraft is a liability which is increasing. We cancel out that plus that will give you 0, so the two sides are equal. Right, then cash was withdrawn to restore the petty cash impressed amount of 500. Your impressed amount is the amount you want to start the month off in terms of how much petty cash you have. Alright, bank is going to decrease here because you're taking money out of petty cash. Out of the bank. So bank will be on the minus side. The money is going into petty cash, so that will be on the plus side. So you have debited petty cash and you have credited bank. One asset, petty cash, going up, the other asset, bank, is decreasing. And then the last transaction, a cash refund was received for stationery returned. If you're receiving money, the first thing that will change here will be your bank, and bank will be increasing because you're getting money. Your stationery is an expense going down. It's as if you haven't bought that stationery if you get a refund. So bank has the X on the debit side, Stationery is the X on the credit side. Bank is an asset going up. Stationery is an expense, but your expense is decreasing here. It's on the credit side. So that will put a plus under O. The lower your expenses, the higher the worth of the business. Now underneath here, I just wrote the word DAS for you. O only changes with DAS. In other words, only change O if you have D stands for drawings, R stands for income, C stands for capital, and E stands for expenses. So it's only those items that get recorded under owner's equity. Alright, as you go through the year, I will post new videos. Please keep an eye out as you move through the year and start new work, because then a video should follow shortly thereafter. Right guys, I hope you found this useful, and I'll chat to you again soon. Thank you.